Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. As interest rates have risen dramatically over the past year, income oriented funds have become more attractive. With the income finally back in fixed income, advisors are searching for new opportunities to generate yield while mitigating risk in their bond investments. That's why Madison Investments, an independently owned investment firm managing 22.9 billion in assets, recently launched its first suite of four income oriented ETFs. The firm provides a range of investment strategies across mutual funds, managed accounts, and customized investment products. It added ETFs to its offering in August, and two of the funds in its suite, the Madison Aggregate Bond ETF, MAGG, and the Madison Short Term Strategic Income ETF, MSTI, seek to capitalize on the growing demand for dynamic, risk managed fixed income strategies. And my guest today will discuss how advisors can use these actively managed ETFs to get the most value out of their fixed income allocations. Mike Sanders serves as the portfolio manager and is the head of fixed income at Madison Investments. So, Mike, tell me about your career path and what led you to join Madison.
Yeah, thanks, Bob. Thanks for having me on. So it's kind of a funny story that I work for a Wisconsin-based company, and so I had interned at an investment company between the junior and senior year of college. Really enjoyed it. I'm a numbers guy, and so investing fit my skill set. But I also applied. I loved economics, and so I applied to graduate school in economics during my senior year. So I graduate from college, and I started looking for a job. But the only full time job I could find at the time was a corporate finance position at a cheese company. So it's probably cheese or beer, right? If you're in Wisconsin. So, which was fine, but I really liked investing. And so I really wanted to try to make that work for a career. But I needed a job. And so I went back to the company that I had interned with and said, I have a job offering for corporate finance role at this cheese company, or I could go to graduate school, but I also need money. And so they were nice enough to hire me kind of a part-time role while I went back to graduate school and finished my econ degree. And if they said no, I'd probably be at the cheese company right now, but they said yes. And so I finished my graduate degree. I did my thesis on trying to predict rating changes for corporate credits and a probabilistic type model. And I've kind of applied that at that company. And kind of here I am in fixed income working for Madison. I came to Madison about 10 years ago. And what really made me come to Madison is it's a great place to work and live. Madison's a great town. But almost as important, we're founder and employee owned. We don't have any outside investors, and so that was really important to me from a career perspective. Is having an ownership stake in a company and help grow it.
So, why did Madison decide to launch active ETFs? And give me a little background on the experience that your firm had in SMAs and mutual funds and how you saw that translating into ETFs.
Yeah, so Madison has a nearly 50-year history of managing client assets and adhering to our philosophy of participate and protect. And we've had a lot of success managing both separately managed accounts and mutual funds. And our view is that active ETFs are just a natural extension for us. We want to deliver our strategies in a structure that works best for our clients. And we see growth in this part of the market, and we think that our risk managed approach is a very compelling offering to investors and to advisors.
So let's talk about MAGG and MSTI. What are their mandates? What are their strategies? What do the funds, the ETFs look like now?
we've been managing multi-sector portfolios for a long time. And, like I said, that participate and protect philosophy, a very risk-centric approach, it's getting applied in these strategies as well. And so the first fund that we have launched for fixed income is, like you said, MAGG. It's an aggregate bond fund. It's a total return strategy designed to be a core holding in a portfolio. Your core fixed income holding has a lot of exposure to different fixed income sectors. So you get a little bit of everything there. The strategy is benchmarked against the Bloomberg US Aggregate Index. So it's going to have that 6-year type duration, a lot of different sectors to invest in. And we do try to leverage all the different sectors to generate performance: corporate bonds, structured products, asset-backed, mortgage-backed securities, non-corporate credit, and treasuries. And because it's an ag strategy and a wide mandate in terms of durations and maturities, 0 to 30 years, if you will, and then also because we do go into high yield and investment grade, it's our best ideas in any part of the fixed income markets really go into these strategies, this strategy, and allows us from a performance standpoint to really do well. Our other strategy is the Madison Short-Term Strategic Income, MSTI. So it's very similar to MAGG with respect to asset classes, but because we've limited the duration to about 3 years, more or less, it'll have a lot less interest rate risk. The objective of that strategy is to generate a high level of income, have lower volatility because of that shorter duration profile, but then again have broad exposure to fixed income sectors to also eliminate some of that volatility. And we really do believe that alpha is best generated through managing exposures to various fixed income sectors, and that's where we try to apply in these funds.
The expense ratio on both funds, I believe, is 40 basis points. And you spoke earlier about your risk-centric approach. How do you manage risk in these two ETFs?
Correct. The 40 basis points for each fund. For the broad, I guess, controls for the fund in terms of where we can move portfolios around. So for MAGG, the duration profile is going to be plus or minus 10% of the aggregate index. And we're going to maximize or have a maximum exposure to high yield of about 10%. For MSTI, again, duration is right around 3 years in a vast majority of the time. But we can own up to 50% of mortgages and asset backs and structured product, or a lot of high yield exposure. And it's really through our active management or active valuations and rotation out of sectors is kind of how we're going to try to generate performance in the strategies. But those are the broad kind of controls of the strategies.
What sets them apart from the many other fixed income ETFs and fixed income mutual funds?
So I think that the unique thing about how we view the world of fixed income is that we're not only focused on one sector, such as credit for performance, or a driver such as duration, let's say, for performance, but we have the flexibility to look at the entire market for performance. Again, we think that a wide variety of sectors is the best way to generate alpha. And so, looking at duration, which is the level of rate changes, yield curve changes, sector industry allocations. So do you like corporates? Do you like treasuries? Do you think corporates are more or less attractive relative to mortgages? And then depending on where we are in the economic cycle and valuations, do we want to own high yield or investment grade? We don't rely on external parties for research. We internally rate all of our own credits, and it really provides us, I think, a unique advantage to have a truly unique perspective on the credits that we own. But it really depends on the market environment that we're in, or where we're going to invest, marginal dollars in the market to generate that performance. I think another differentiator of our strategy is that we're only focused on fixed income. We don't have derivatives. We're not having equities in this fixed income portfolio. We believe fixed income should act like fixed income. We're not trying to invest in other stuff, not fixed income, because I think when volatility hits, it's going to have a negative impact on performance. And finally, we believe that our size is an advantage. We have an AUM level that allows us great access to institutional pricing. We can get in on deals, but it also allows us to be nimble and move in and out of sectors that we think maybe are attractive or less attractive given the environment. without really having to move the market, sell a bunch of bonds. Liquidity is touch and go sometimes in fixed income. And if you're trying to actively shift your allocation, it might be harder if you're trying to move a lot of bonds, and we don't have those issues. We can be really active and try to take advantage of opportunities that we see.
I looked at the holdings last night, and I think MAGG had most of its top holdings, at least the top 10, were in U.S. Treasuries. MSTI was much more allocated towards credit. How does that reflect on your view of the markets right now?
Yeah, so in MAGG, yes, we do have a pretty decent treasury allocation. We also really like mortgage-backed securities as well. We think that's an opportunity in the market. When you compare that relative to other sectors, it makes sense to invest there. On the MSTI side, yes, it's going to be heavily weighted on credit. We think that the front end of the yield curve, given where rates are and where Fed policy is, buying high quality credit makes a lot of sense from an all-in yield perspective. You can get well north of 6% in some names on a diversified portfolio, and we think that's very attractive right now in this environment.
So you mentioned the front end of the yield curve right now. I think you can get north of 5% on 6-month or even 1-year treasuries. That is very tempting to many investors, and I think the mantra is now T-bill and chill. What is the appeal of a fixed income product like yours?
So I think it's really getting that diversified exposure to all sectors, right? I mean, you're 100% right. Buying a T-bill at 5.5 or whatever the number is, and just sitting it out makes a lot of sense. But it's a lot of uncertainty going forward with if the lags in the economy are going to hit or when they're going to hit in terms of interest rates, and locking in yields and performance going forward with pushing out duration, having different exposures to asset classes, I think makes a lot of sense. I mean, you'll never get the timing perfect, but I think layering in a more diversified fixed income portfolio, I think makes a lot of sense right now, given the current environment that we're in.
Why did you choose an active ETF versus, for example, an open-end mutual fund? And why would investors want to go with an active fixed income ETF? And also talk about where you're seeing the allocations go to in your client portfolios.
Sure. So for MSTI, we used an existing separately managed account strategy that we had a lot of success with with other wealth management clients. For MAGG, it was a offshoot of an existing mutual fund, slightly different. We didn't want to clone the strategy because of the availability in the different intermediary channels, and we didn't want to have any conflicts with our partners. And so, from our view, we think there's a place for both ETFs and mutual funds, and we want to distribute both of them. And we have no problem, waiting, I guess, and developing our ETF track record going forward. So that's kind of why we decided to add that to the market. So why active fixed income ETFs? Where does it fit? So our view of fixed income is that it should be a core holding in a client's portfolio, and we think that it fits well given how we view the market of being a very risk-focused investing style. Our goal is to create a portfolio that has lower risk versus passive alternatives, but also have ability to reduce risk in an overall asset allocation through, again, having exposures to various different asset classes and trying to have a little bit less correlation to other parts of the market. You've seen us shift because of the soft landing getting priced in. There's been a lot of demand for high yield bonds, which has done very well. If you look at history, when volatility hits, high yield acts like equities. And so you're not really diversifying your risk and reducing your risk. In some sense, you're adding to your risk. So we view active fixed income, how we do it, and the risk approach is a way to have less risk overall. And if we can manage it correctly and deliver solid returns, we'll reduce the risk of the portfolio. They can take on risk maybe in other places of the allocation.
Where are we now in the interest rate cycle? And given your view of that cycle, how does that translate into your approach to managing the bond portfolio now? And where are you seeing the best opportunities?
The cycle, we think, everybody uses the baseball analogy, but in terms of hikes, late innings, maybe the Fed does one more, maybe they don't. I guess we'll see how the data gets released. But I think the shift that you've seen is the market's finally pricing in the higher for longer type framework, where before they thought cuts would occur in the next quarter because of all the hikes that the Fed had done. Now there's more of an appreciation that maybe the Fed will be able to keep rates higher for longer. And so in that kind of environment where there is still a lot of uncertainty and the curve is kind of inverted, we just think that staying active to this environment is really how you should be approaching it. It just allows the portfolio manager, we're looking at the information every day in the markets, to have us add the value through allocating in areas that we see opportunities in real time versus kind of waiting and maybe allocating a little bit late to the parts of the market that are attractive. In terms of where we think value is today, we think an agency MBS is very attractive, as is asset-backed securities, so that structured product, securitized product area. And given the wide range of interest rates over the past 5 years, let's say, there's a lot of low coupon mortgages that have 30-year maturities to them, and there's a lot of now high coupon mortgages that have 30-year high coupon mortgages. And so not everyone necessarily is attractive at any one point in time. So I think that's why going with an active approach, there's a sector that's attractive, but I think going active makes the most sense because it allows the managers to pick and choose where they think the value is and allocate appropriately to those sectors, and even parts of the subsectors. Asset backs we also think are attractive, high quality assets, great part of the yield curve on the front end, and again, lots of great carry on the front end with a little bit less risk on the credit perspective, given their high ratings. Within corporate credit, we still think that financials are attractive. Banks got beat up a little bit post the Silicon Valley Bank and some of the failings that we saw there in that sector, but there's still a lot of value there in the financial area, especially when you compare it to parts of the industrial market. And some of those spreads are really, really tight. I think there's better value in corporate credit within the financials and banks.
So mortgage backs, asset backs, and financials. I'm wondering what is driving the attraction of mortgage-backed securities. Is it the fact that rates have gone up and it basically eliminates or greatly reduces the likelihood of refinancing? Is that the key driver there?
Yeah, that's part of it for sure. It's there's you can buy not deep discounted, but discounted mortgage-backed securities that are AAA rated. So you're really taking that refinancing risk away. And so if I can buy a AAA rated asset that's maybe 5 or 6 points below par, right? If the underlying loans refi for some reason, now you're going to buy something for 95 cents on the dollar, it pays you back at par. It's a great deal. And if rates do fall, you still have 5 points of appreciation before maybe more of those borrowers will refinance. So it's a credit up in quality credit play, and just from an overall relative valuation, they're attractive versus kind of other parts of the market.
If there's one key takeaway that you'd like to leave with our audience of financial advisors about how to evaluate the risks in a fixed income offering such as yours, what would that be?
The big thing to focus on is really where people are trying to generate performance and what the risks they're taking. If there's a manager that is consistently looking for performance through credit, either being a little overweight credit or a lot overweight credit, I think that you could be surprised when you have volatility hit the market. If you think about where we are now in rates, almost the entire treasury curve is above inflation right now. And so if you add spread on top of that, there's a lot of opportunities for positive real returns going forward in fixed income. And so with a wide variety of sectors and securities, allowing a manager that really has the opportunity to look everywhere in terms of allocating money, I think is really an advantage versus managers that maybe focus on one area or the other. There's a lot of opportunities out there, and having a manager that really kind of focuses on everything, I think is the better the better play in the current environment versus being a little bit more focused in one spot.
We will include some links to resources in the notes that accompany this podcast. We can learn more about Madison Investments. There'll be a link to the Madison website, a link to information about the two ETFs that we've discussed, MAGG and MSTI, and a link to be able to follow Madison on LinkedIn. Mike, is there anything else you'd like to add?
I just want to thank you, Bob and Vetify, for having me on.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopshire, and today featuring Mike Sanders of Madison Investments. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.